So what a difference a week makes. Last week's euphoria gave into this week's panic selling. We discussed some of the different anomalies out there and how to make some sense of it. So how quickly things turn around. Last week's euphoria, as I mentioned in the intro, is now given into Thursday's panic selling. Some interesting things that start to manifest when you're near-term market tops that when you really step back and think about them, don't make any sense. Here are a few of my favorites for this week. You have Chesapeake Energy bonds trading at 5 cents on the dollar, all but telling you that company is doomed, at least as we know it today. And yet the stock is up significantly off the lows and trending upwards of late, at least before Thursday's close. You have Hertz coming out and saying they're going to issue $1 billion in new stock. At the same time, they're headed into bankruptcy. Literally the headline today, Hertz shares surge on a plan to sell $1 billion in stock that could get wiped out in bankruptcy. If you're saying to yourself, well, that doesn't make any sense to me, it's because it doesn't make any sense, and yet that's the market we're in. You have TD Ameritrade coming out and saying there's been a surge in new account openings and a surge in viewership of their investing basics. Again, confirming what we've been hearing for some time, which is the amount of retail investors flooding in and really gambling within the stock markets is peaking. And again, that's something that's very typical near all-time highs, is that fear of missing out, that greed factor takes over within so many investors. If you're looking for something more fundamental, we look to the Fed. They came out this week, and while they certainly tried to allay concerns by saying we're here to do whatever it takes, they also had a couple big important announcements that investors should have been paying attention to. One, which is their pretty tepid outlook for growth, believing the GDP growth and GDP levels won't get back to 2019 levels until 2022. Again, as I've mentioned the last few times, that type of an outlook does not make sense in light of a market trading at a very high multiple, top 10% valuation. The second big announcement, which there's a great chart in the written commentary below, was that they're going to be pulling back the expansion of their balance sheet from $550 billion a month down to $120. Still big numbers, but it's for something that's been as supportive of the market. Again, that's what that chart's about. To have that being pulled back is something that bears watching given the fundamental backdrop. Last thing I'll share you is just a couple anecdotal stories. I'm going to mishmash a couple non-client conversations I had this week that really, again, explain how these types of emotional drivers that in the calm, cool collectiveness with a third party may not make sense, can suck you in when left to one's own devices. I was talking to a couple guys this week, and all of whom were talking about the stocks they were investing in, high growth names, kind of some junkier type stuff, that they were going to give up on some of the more diversified parts of their portfolio to chase equities. And then I asked them, well, how are you justifying that decision, if you will? How do you explain overcoming that 3 standard deviation overbought level from a technical perspective, or all just the fundamental deterioration in terms of earnings and growth being so far pushed out? And all I got really was, these again good guys, but was blank stares in return. Their justification after we got done explaining what I had been talking about was just all about past performance. Again, there's a reason people tell you past performance is not indicative of future results. It's because it's not. So what does this leave you with? Well, know your plan. Number one, be emotionally prepared. I share these data, these stories, not to, again, tempt you into trying to predict a market movement, so it's more to emotionally prepare you for what might be coming down the way so that you don't get a panicked response that leads to a bad decision. Ultimately, it's far more, again, about maintaining diversification. Again, great chart in the commentary below. I get it. Markets have been hot, FANG plus stocks have been hot, but if you step back, if you really want to have success over a long period of time, look at the chart below that shows a 20-year look back and how a diversified portfolio not only gave you the performance of the US stock market, but did it with less volatility, fewer drawdowns than, again, just a stock portfolio. There's a reason why people say you should be diversified. It doesn't work all the time, but it does work over time. Second thing is, know your plan. Plot your course and stick to that course. The sticking is even more important than the course you've plotted. But so many times, again, people are being zigging and zagging, letting those twin emotions of greed and fear pull them off course. We want to get you on course. To that end, I want to lay out 3 general ways, particularly my retired clients, can be thinking through the types of courses they can plot. A new acronym for you, CPR, how to avoid a heart attack in retirement, we'll cover right now. So real quickly, I'm going to walk you through this. This is something that's going to have to be unpacked a lot more over a few weeks. But real quickly, 3 different courses that one could plot to stay safely retired and push out the longevity of their portfolio. One is a cash flow based methodology, the C, a probability based methodology, kind of a regular methodology. Think your 60-40 S&P / US bond type strategy. For cash flow, the pro is real simple. If we can generate a 4 to 5% income stream and map that based off your assets to 4 to 5% distributions, we can push out the longevity of that portfolio almost indefinitely because, again, we're just spending what we make. The con is it's very diversified in a lot of asset classes that people may have less familiarity with, and so how it's acting compared to what you might be reading about in the headlines or one of your other more traditional based strategies isn't going to look the same, and that can be a consternation that's difficult for some people to come to understand and get over. The second are more probability-based methodologies. Think a Monte Carlo simulation. These basically look at all the different types of permutations and market returns that one might get, coupled with what you're spending, to let you know what your odds of success, not dying broke, are. They certainly have their own validity. A pro is you can use a lot of different, even more familiar asset classes like the S&P 500. The con is you bring in some sequence of return risks. We're going to unpack this here again in a couple weeks, but in short, that if you get into a few years of bad markets, you could have real drawdowns. We started playing around with some numbers this week that I think will surprise you when we share them again in a future video. And then you have the regular methodology. This is kind of your classic 60-40 mix. It's this type of mix that people are very familiar with. And so again, when you think about familiarity versus maybe effectiveness going forward, these are people who want to lean into that familiarity. So the pro is just that it's something that's going to act like you expect. The con is that 40 of that 60-40 mix right now, when you look at bonds again, is at 1.5%, 1.7%. It's not even going to keep up with inflation. It's not going to be that 6-8% plus some capital gains as interest rates have come down that people have been accustomed to and has really buoyed these up through even dark days for the S&P 500 like the decade of the 2000s. So this CPR, can't wait to share the report. We've got our crack new intern, Patrick, working on it along with Adam and Ryan to bring this and flesh this out. But again, they all can work. The key is knowing your pros and cons, accepting the cons, and staying the course. So to wrap up, the keys to long-term success in an investor is 1, don't panic. 2, don't buy into prophesying type strategies that are trying to predict the future of market movements. Just have a process. Plot that course. Wherever it falls on the deal, understand your pros and cons, that there is no such thing as a perfect strategy, but there can be the perfect strategy for you. With that, thanks so much for joining us. Next week's commentary comes with a very exciting announcement.